Welcome to the Patreon, everybody. Let's break down my trading strategy. So I strictly use supply and demand zones when I trade. I don't use any other indicators. A supply zone is an area where the selling interest is stronger than the buying interest, which leads to a violent move to the downside for the stock or the ETF or the crypto even, whatever you're trading. A demand zone is an area where the buying interest is stronger than the selling interest, and that leads to a violent move to the upside. So, supply and demand zones are never the result of retail traders. It's never because me or you. It's always because of a large institution placing massive orders. They're the only ones that can move the market to such an extent. So, I'm purely a technical trader. The exact fundamentals of why a big move happens doesn't matter too much to me. I strictly trade what I see on the charts. I do, however, take into account the overall sentiment of the market. If we're trending upwards very strongly, I will be very wary of that. So how do we find these supply and demand zones? You want to find an area on the chart where the price has made a strong move up or down after a period of consolidation. That's a sign of an imbalance between the buyers and the sellers, and it indicates a potential supply or demand zone. So let's take a look right here. Here we see on the chart the S&P is moving upwards, kind of in a balance zone, and then we see a very sharp move down, right? This is the exact type of move we're trying to look for right here, where there would be a supply zone, specifically because of this balanced period and then a large move down. Then we see it move down a bit, it follows through, trends back up a bit, and then here we have another balanced region. This is on the 30-minute, and then an even more very violent move down. Just look at how much farther this move down is compared to this one and how much more volume there is. This is a clear supply zone. It's a very, very strong zone. You can judge it based on the move down. So we are going to draw our supply zone box here. So how we draw the zones, as you see, for a supply zone, when you look at the balanced period right before, you want to include the top wicks. You want to include those top wicks because that's the whole range of that zone. But then on the bottom zone, you only want to include the candle bodies. So that's how you draw a supply zone right there. If you take a look, eventually the S&P came back up to around that level. It didn't necessarily hit that box, but it came back around that level and it came back down from there again. Let's take a look at another example. Again, here you see we're looking at the 1 hour chart on the S&P here. You can see here there's a nice big move to the downside after a period of consolidation. What do? We look at it right before that big downside move happens. We draw our zone, we include the wicks to get the whole range, and then we include the candle body that came right before the zone. Here's another example. This is on the 15-minute for the S&P. We see here in this period overall, it kind of seems like it's trending downward, but if you look, it really isn't. It's kind of in this balanced box right here, but then the first big move happens right here, this big red candle, and then after that there's a big follow through to the downside. So we take a look and we find this region right here to be our supply zone. We want to include the top wicks and then we close it at the candle body. Now let's look at demand zones. It's the same thing as a supply zone, but the opposite. You want to look for where there is a violent move to the upside. So here we have that here. Big move to the upside here. So we're going to go and take a look. Where did that change? And it happened right here. So as you see the demand zone, same thing. We're going to take those two candles right before the move started. We're going to get the wicks on the bottom to encompass the whole range of the zone, and then the candle body on the top. Here's another example. This is on the 1 hour chart. We're going to get later into the time frames and what time frames you should be looking at later on in this video. So here again, massive move to the upside, a lot of volume. We take a look right before the move happened. This is in the span of 2 hours, a balanced range. If you look, this whole range is very balanced. But we want to look at the candles right before the large move. That's called the basing candles. So what do? We draw it. We encompass the wicks on the downside for the whole range. And we draw it on the candle top, on the candle body on the top. Here's another example on the 1 hour chart. Just pretend this demand zone wasn't drawn yet. You take a look at this chart. The move that stands out the most is this one right here. Big violent move to the upside. So what do? We look at where that move started. We look at the candles before that, try to find the basing range. Here we have it. Again, you want to encompass the whole range. So wicks on the bottom. Sorry, you want to encompass the whole range, wicks on the bottom, and then finish with the candle bar on the top. Let's take a look on the 5-minute. These supply and demand zones are created in all time frames. You can find them in all time frames. And which time frame you draw and trade them on really has to do with your trading style. Again, we'll break that down later. But let's just take a look at a 5-minute demand zone. You see here, the S&P is ranging and then has a very big move to the upside. So we say, okay, here's a demand zone. Look at the volume too. A lot of orders here. We draw out the zone, and then what happens? S&P comes down to the zone, goes back up, comes back down into the zone, goes back up, comes back down into the zone, and continues going up. Now look, you see how we encompass the wicks here? If we didn't, a lot of people don't, and they'll do it at the candle body. If we did it at the candle body, you get stopped out, you get stopped out, you get stopped out every time. But if you encompass the wicks, you are not getting stopped out of that trade. Normally in a situation like this, by the way, when you draw a demand zone, you want to take the trade the first time it hits that zone, because the volume and the orders that are left unfilled here, they're going to be the most fresh when it comes back into the zone. The orders that were not filled, they're going to get filled. They're going to get filled. They're going to get filled. And then eventually there's a higher chance of that zone breaking to the downside. This didn't happen here, but it is something that you need to be aware of. So here's another example of a demand zone. Here we're looking on the 4-hour. Very clear, this massive candle movement upwards. And then take a look at the 1, 2, 3, 4 candles before that. So that's 16 hours of a balanced period. And then this massive move up. Very clear demand zone. And since this is on the 4-hour time frame, this demand zone might be a bit larger, might be a couple more points. But this is a great overall zone to take into account if you're swing trading. I wouldn't really use a 4-hour zone to day trade on the 5-minute candles, but I definitely would use it on larger period trades. Here's actually that same demand zone, but on the 30-minute time frame, just so you can see what's going on in those 4-hour candles. So you can see even on the 30-minute, this move upward is just so violent. So again, look at this. Encompass the bottom wicks and then the body of the candle right before the move. We did the same thing here. Bottom wicks, candle body. So to trade with supply and demand, you want to buy at demand zones or go long or buy calls, and you want to sell at supply zones. You want to short the market or buy puts if you're trading options. Why is that? Because you're expecting a demand zone for the buying pressure to push the chart back up, and at the supply zone, you're expecting it to push it back down. So let's talk about time frames. I like to start off finding zones on higher time frames and then trade on lower. So since I'm day trading and I'm usually trading on the 5 to 15 minute time frame, I like to chart my zones on the 30-minute to 1-hour time frame. And of course, the smaller I go on the time frames, I will adjust the zones. And then when I'm looking for intraday zones, new zones that are being formed during the market, those also, I like to look on the 5-minute, like one of the examples we saw before, just to get a more detailed view of where the zone is. So let's take a look of how you would use these zones to take a trade. As we can see here on the picture, this was a Friday here where the demand zone got created. We're looking at the 30-minute. You can see the demand zone. How do we find it? Big, violent move upward and a follow through. So we go, where's the zone? Right here, we start at the candle body. We encompass the wick. And then when it comes, then this is the next day. This is on a Monday. And we want to look for a trade entry. So we wait at 1 p.m. here. The S&P comes back down to this demand zone. So we take a trade here. We set our stop loss at the bottom of the zone. And then as we see, after an hour, the S&P came back up. And then we definitely had a 2-to-1 risk to reward trade right here. And then you can see even later, it came back down to that same zone and then shot up even more. So this was a great zone right here. We want to talk about risk to reward. It is one of the most important things you need to take into account when trading, which a lot of people overlook. The concept is simple. You need to have a good ratio of what you're risking to what you're willing to make on a trade. On a minimum, I always like to have a 2-to-1 risk to reward ratio, which means, for example, in this situation here, I was risking 6.5 points to make 13 points. So in this situation, let's say I'm risking $100 to make $200. So this trade here, exactly what I have drawn here, this trade here would have gone way past a 2-to-1, and it would have hit a 2.85 to 1 risk to reward ratio if we let it go all the way to the top of the zone, which in this situation was right here. So now we're going to look at a short opportunity on that exact same area. So back there, we can see here a supply zone formed. And if we charted that all the way, this is what it would have looked like. This is on the 5-minute. This was on the 30-minute. And we would have seen here that the S&P ranged in this whole area. And then it hit the supply zone where we could have taken a short trade, put our stop loss at the end of the zone where that wick was. And then if we're going to draw a 2-to-1 risk to reward ratio, this is how it would look right here. We'd be risking 3.5 points to make 7 points. By the way, this area right here that you see in the bottom right is this area right here. It's just on a smaller time frame. This is how you see that it looks on a smaller time frame. So as you see here, if we took this trade here, a 2-to-1 risk to reward ratio, this blows past that. So sometimes what I like to do, if I'm in a position with, I'm shorting more than one contract, I have more than one contract of puts, sometimes I will hold a couple. I'll sell half my position, 75% of my position, and I will let a couple more go, but keep a tight stop loss on those so they do not turn into a loss. Because you get a lot of opportunities like this where you close a 2-to-1 move, but the whole move could be way more. And this situation was a 5.3 risk to reward. But again, use caution on this. This isn't going to happen often. It's always safer to get consistent 2-to-1 trades or 3-to-1 trades. It's easier to get those consistently, and in the long run, it's better if you aim for those. Let's talk about supply and demand zone failures. They are inevitably going to fail. That is because the orders that were left there unfilled that create the zone eventually will get filled, and there is going to be a much larger pressure going in one direction. This is why we always like to look for some confirmation that a zone isn't about to fail. The most important thing you can double check is that when you take the trade, it is the first time the zone is being touched, because that is when there will be the most unfilled orders. There won't always be a clear confirmation. Some people like to check that there isn't an engulfing candle on the way down or the way up, depending on if it's a supply or demand zone. A lot of the time, I just know that if my risk to reward ratio is correct and it's a setup that I know majority of the time it's going to go my way, I am comfortable entering the trade, the start of the demand zone or supply zone, and having my stop set at the end of the zone.